It is important to start budgeting for the GST increase. It is better to be prepared than to ignore it and let it creep into your budget. Hello and welcome to another episode of Moneywise. We help you to make sense of the world of personal finance and investing. In today's episode, we're going to look at ways other than inflation that leads to rising costs. GST hike. We all know what GST is, but here's a quick recap anyway. Goods and Services Tax, or GST, is a broad-based consumption tax, and nearly all transactions include a GST charge, save for a few exceptions which are GST exempt. Some examples of transactions that are GST exempt include certain financial services, such as obtaining a bank loan, or for real estate, the selling or leasing of residential property. Here's a fun fact: the import and sale of investment precious metals is also GST exempt. So if you purchase physical gold or silver bullion, there is no GST charged. Now, an increase in GST is going to affect every aspect of our lives, given that GST is charged on most transactions. The Singapore government has announced that the GST hike will be in two phases, with GST rising 1% each time. First in 2023 on January 1st, and the second one, 2024, also January 1st. Since GST can be found in everything, including your utilities bill, it is important to start budgeting for the GST increase. It is better to be prepared than to ignore it and let it creep into your budget. Doing this also helps you to prepare for it mentally. Calculate budget and spending. To calculate budget and spending, you should first tally up your total monthly spending. This spending amount already accounts for the current 7% GST. Hence, you take this total spending amount divided by 107. You then take this answer and multiply it by 109, and you'll get the higher amount that you're likely going to be spending every month. For example, if you spend $2,000 per month, then you take 2,000 divided by 107, then multiply it by 109 to get $2,037. Assuming your spending habits do not change, then this is the new amount you would be spending after the full GST hike. Next, we have rising interest rates. To understand why interest rates move, let's take a look at economics. When the central bank of a country wants to stimulate growth in the economy, usually to exit a recession, they will lower interest rates. This encourages companies to borrow money to invest and expand their business, and in doing so, helps to create jobs. When people have jobs, they feel more secure about their finances and thus spend more, increasing consumer spending, which in turn helps to fuel economic growth. However, when a country's economy becomes overheated and inflation starts becoming a problem, the central bank will increase interest rates. This then forces companies and people to lower their spending because they now have to pay more to service their debt obligations. Lower consumer spending helps to stabilize and eventually reduce prices. This is why in the US, interest rates have been raised, and several more rate hikes are forecasted for this year, because the Federal Reserve is aiming to control runaway inflation. In a game, interest rates are like a macro event affecting everyone in the arena, from new players to experienced players. Why this affects Singapore? A hike in US interest rates affects us all the way here in Singapore because Singapore is an interest rate taker, and our borrowing costs tend to track the US interest rates closely. Unlike other central banks, the Monetary Authority of Singapore, or MAS, combats inflation by managing our exchange rate against our major trading partners. MAS does not directly set interest rates. In Singapore, banks use interest rate benchmarks to calculate the interest rates they will use. We have three in Singapore. First, the Singapore Dollar Swap Offer Rate, or SOR. Second, the Singapore Interbank Offered Rate, or SIBOR. And third, the newest of them, the Singapore Overnight Rate Average, or SORA. Take note, SOR and SIBOR are being phased out in favour of their replacement, that is SORA. As the federal funds rate rises this year, we can expect SORA to do the same, in step with the Federal Reserve. How interest rates affect you? If you have any outstanding debt, such as a mortgage from a bank, car loan, or a commercial loan, chances are you could find yourself having to pay more to service these debt obligations as rates rise. Even if you are presently on a fixed rate mortgage, you will have to face the floating rate eventually once your fixed rate period is done. Currently, some banks have stopped offering fixed rate packages and are only offering floating rate packages. It is therefore advisable that you quickly rebudget accordingly to see where you stand financially and make any necessary adjustments so you do not find yourself stressing over debt repayments. It is better to prepare than to be caught off guard. Now, those of you on HDB loans can breathe a sigh of relief. That's because HDB's concessionary interest rate is pegged at 0.1% above the CPF Ordinary Account or OA interest rate, and this has not changed in more than 20 years. A note for those of you renting a property: if your landlord is affected by rising interest rates, be prepared for a rent revision upwards when you renew your lease. How interest rates affect you. Indirect: debt repayments forcing price increments. Landlords and business owners with significant outstanding debt could face cost pressures from their debt repayments. Faced with these higher costs, prices for you as the consumer could go up too. For example, if the landlord of a coffee shop is faced with higher debt repayments, they may choose to raise the rent for their tenants. As a result, the stallholders will also have to raise the price of their food to survive. You, as the consumer, will now have to pay more. If not, it is only expected that stallholders will have to pull out even after operating at the same place for more than a decade. In conclusion, prices and interest rates will likely continue to rise and will affect everyone, either directly or indirectly. The main thing is that you do not panic. At the same time, don't be idle. Rebudget and reevaluate your finances to see if you're impacted and if you need to make any adjustments. If you are affected by rising interest rates, consult your relationship manager or mortgage broker for advice. Above all, do not be caught off guard. Thank you and see you again for another awesome episode of Moneywise.